The Fed is stuck between a slowing economy and persistent inflation. If a recession hits, what happens to mortgage rates and house prices next? Will the Fed be forced to cut rates aggressively? Or are we just looking at prolonged market volatility? In today's video, we're going to talk about what's currently driving mortgage rates, as well as what's likely to happen over the next couple of months. At the time we're filming this video, the futures market has priced in 3 rate cuts for 2025, while at the same time, Fed Chair Powell is saying that the Fed is awaiting greater clarity on Trump policies before making its next moves. In addition to that, you have the Fed's Kugler saying that the Fed should hold interest rates amid the idea that inflation isn't gone, which in turn is creating a lot of volatility in the market, causing interest rates to plummet to the lowest levels that we've seen in 4 months. And one of the primary reasons for that is because we have this idea out there that a recession is on its way. And if that wasn't enough, you have President Trump ramping up tariffs on steel and aluminum from Canada upwards of 50%, which ultimately sent a complete shock through the stock market, with the S&P down almost 10% for the year, the Dow down over 8%, and the NASDAQ down over 14%. Now, normally when you see this happen, money would come out of the stock market and flow into the bond market, which in turn would drive the 10-year down and mortgage rates would follow. But paradoxically, what we've seen happen is money has come out of stocks, but unfortunately, it hasn't flowed into bonds. And because of that, we've actually seen the 10-year trickle up, causing mortgage rates to come off the recent lows that we just saw. Now, if all of this is really confusing, I completely understand. And that's because the market isn't reacting how it would normally react, especially when you look at the 2 main things that the Fed is watching in order to deliver Fed cuts. As you probably know, the Fed has a dual mandate. The first is to maximize employment while at the same time creating stable prices. So in layman terms, the Fed essentially wants to keep the unemployment rate low while at the same time keeping prices from going up too much. But here's where it gets confusing. CPI just came in lower than expected, sitting at 2.8% year over year, which is better than the expected 2.9%, marking the lowest level of headline inflation since November of 2024. At the same time, we had core CPI falling to 3.1%, which is the lowest level that we've seen since April of 2021. And if that wasn't enough, we also have shelter inflation cooling, which has been a huge lagger when it comes to the inflation numbers, and one of the main reasons that we've seen inflation remain sticky. Well, it came in at the lowest level that we've seen since January of 2022 at 4.09% year over year, which is a really strong sign that CPI is likely to drop further. And when it comes to the employment front, we only added 151,000 jobs in February, which was less than the expectation of 170,000, taking our unemployment rate from 4% up to 4.1%. And when you look at the drop in participation rate, employment is actually closer to 4.3%, which is the weakest levels that we've seen since 2021. All of this tells me that we need more certainty in the market. While inflation is cooling and we do have some job market instability, I believe that the Fed and the market really want to see how these higher tariffs could impact inflation, which in the meantime is likely going to force the Fed to delay any rate cuts, keeping mortgage rates volatile for the foreseeable future. And because of that, I think it's going to take a lot more negative news to get interest rates to move in a meaningful way. Over the last couple of months, we've seen mortgage rates range somewhere between that 6.5% and 7.25%, which in my opinion is where we're likely to spend most of 2025. Now, that doesn't mean we can't see lower mortgage rates. It just means it's going to take a lot more for mortgage rates to move down than it is for them to move up. So what I'm saying is any piece of good news out there is likely to impact mortgage rates in a positive way, but you're not likely to see quarter point, half point moves with good news. But on the flip side, news that shows the economy is still strong, inflation is still high, likely means higher rates. So the question is, when will the Fed cut rates, and how will a recession actually impact mortgage rates and house prices? Before I get into that, do me a favor and drop me a comment below and let me know what you think. But to answer that question, yes, I do think the Fed will cut rates in 2025. But as I've said before, the futures market is already pricing in these rate cuts. So if the Fed delivers on what the market is already predicting, it's likely not going to impact mortgage rates in the way that you want to see. And that's because it's already built into the cake. That's exactly why last year when the Fed cut the Fed funds rate by 50 basis points, we actually saw the market move the other direction. And that's because the market was already anticipating that. So while I do think the economy is slowing, inflation inflation is slowing and will continue to slow, I don't really think the Fed is going to go too far from their current game plan because they don't want to loosen interest rates too fast, because these tariffs that are currently being enacted on Canada, on Mexico, on China aren't likely to impact inflation immediately. It's going to take time for this stuff to work its way through the economy. And as it does, I think you're going to see the economy continue to slow because prices are likely going to go higher, which means less disposable income out there in the market, which is not only going to impact GDP, but it's likely to send the economy into a recession at some point in the future. You have to remember, we've been on an upward trajectory for almost 14 years. So just like home prices, you need some consolidation. You need things to move sideways in order to get back to that long-term trend. And because of that, I do think you're going to see lower mortgage rates in the future. But here's the thing, it's not going to happen in a straight line. We see a lot of volatility in the market. Last year in September, we saw the lowest rates that we've seen in a couple of years, with FHA and VA buyers being able to get somewhere around 5%, with conventional loans ranging between 5.5% and 6%. But since then, we saw interest rates shoot up to almost 7.25%. So if you're out there in the market right now, you're buying, you're trying to refinance, you need to take advantage of these opportunities when they present themselves. Now, this isn't a push to get you to go out and buy a home. You should only be buying when it's the right time in your life. But at the same time, I wouldn't be trying to pick the bottom in interest rates either, because of all of the volatility out there in the market. So with that, I do believe there's room for mortgage rates to move down over the next couple of months. I also believe that there's a chance if they move down, they can bounce back up just as quickly. So how will all of this impact house prices? My guess is you're going to see much of what you've seen over the last year or so. You're going to see markets that have insurance issues, that have tax issues, that have natural disaster issues. You're going to see inventory in those markets likely grow, because not only are higher mortgage rates impacting your monthly payment, you're now also having to deal with higher insurance costs, higher HOA dues, as well as the unknowns of what next year brings with regards to prices. And that's one reason that we've seen inventory grow so much in areas like Florida and Texas and Louisiana, because these are the markets that's been impacted by it the most. But at the same time, you still have a large majority of the United States below pre-pandemic levels when it comes to inventory. So while I don't think you're going to see 5, 10, 15% appreciation like we saw the last couple of years, I do think there's a high likelihood that you see home prices continue to appreciate somewhere around the rate of inflation, 3 to 4%. And because of that, I don't think there's a rush to go out there and buy a home. But at the same time, I do believe that sitting on the sidelines, waiting for lower prices, waiting for lower rates, likely means you're going to pay more in the future. So just remember, while mortgage rates have declined because of recession fears, there's that chance that better employment, higher inflation could keep interest rates from dropping further. And while a recession is likely to lead to rate cuts, it's also likely to bring financial instability to a lot of people out there wanting that recession. So if you're somebody currently sitting on the sidelines, let me know in the comments what you're waiting for. Now, if you're one of those people that just commented that you're waiting until interest rates move lower to buy, I'd actually tell you to check out this video here where I talk about why buying with a 7% interest rate is actually smart.